If you have invested just $10,000 in a company like Nvidia right before the pandemic started, today it would amount to something like $300,000 or almost $300,000. And it's an insane amount of investment because you're just investing a small amount of $10,000. And if you would be a little bit more generous and you would invest not just $10,000, but $20, $30, or maybe $40,000, today, you would have almost, or not almost, over $1 million just by investing an amount of $40,000. And some people might say, what is the point of looking back and regretting why I did not start investing 5 years ago, 3 years ago, 7 years ago? But the fact is that a lot of people get interested in investing when there is a hype, when a stock goes up, and they're like, oh, I wish I started investing. But if you kind of take a deep look into it, you will realize that Nvidia wasn't the only stock that people invested. Nvidia wasn't the only stock that grew substantially. There are multiple other examples. Maybe Nvidia stood up as the stock that actually grew by 2,700%. But there are plenty of companies that grew by 1,000%, 500%, 800%. 2,000%. So if you actually got interested in investing back then and started, you would actually have made a lot more money. Not maybe $300,000 by just turning $10,000, but you would be significantly better off than you are today. Remember the example of GameStop when everybody was interested in investing? What happened? There was a period of time when everybody wanted to buy GameStop shares. But then when the hype was over, people forgot about GameStop and the stock market overall, and that was basically the end of their investing career. I'm not saying that it's easy to actually get $10,000 because if you kind of take a look at the data, you will find out that the vast majority of Americans don't even have an extra $1,000 emergency. So I'm not even talking about an amount like $10,000 if you can't even get $1,000. But it's really fascinating that we live in this age when anybody can actually just invest $10,000 in the stock market because everybody has access to the stock market, and they can turn that amount in a period of 3, 4, 5 years into something like $200,000 or $300,000. Yes, $300,000 might not really seem like an insane amount of money that can change your life because most people, for example, in the US will make a couple of millions of dollars throughout their entire life. But it's one thing to make that much money in your entire life, but another to have that kind of investment because $300,000 literally can get you a house in some places. Of course, not in a place like California or New York, but when the median house price is around $400,000, $300,000 looks a lot. And even if it does not get you a house, for example, it can be the down payment or pay like half of the price of your house. So if you actually missed the opportunities in the past, don't worry. There is a market cycle, companies go and come, companies rise and fall, and there are going to be plenty of more examples that companies are going to grow substantially. So let's say that you've actually saved $10,000 and now you're looking to invest that much money. What exactly should you do? What exactly should you invest? Which stock exactly should you buy? Well, the first advice that, or I would say the first suggestion or recommendation that I have is that please don't rush. Hold your stocks, hold your money. Don't rush into investing. And I know that a lot of people might actually get excited because they're looking into those stocks and they're growing and they want to buy that stock as soon as possible, especially when you see that everybody is making money and some of the smartest people out there make this mistake. But don't rush, because if you actually rush and you make the wrong investing decision, you might just lose all of your money. You might lose 70% of your entire money. If that stock is already in the news, you're probably already late because everybody has invested in that stock and that stock might actually be hyped. I'm not saying that that is the case with every other stock out there, but quite often that's the case. And a good example I can give you is probably Zoom. Now, don't get me wrong, Zoom is a great company and they are doing great services out there. But remember, there are people who actually bought or purchased Zoom stocks when they were worth like $500, $600 almost at their peak, probably like $580. And guess where the price of Zoom is right now? It's literally down by 87%. Those people who purchased the Zoom stock at their peak lost almost 90% of their money. I'm not saying that Zoom is a bad company, but if you actually buy the stock at the wrong time, if you don't know your numbers, if you actually rush to buy the stock just because everyone else is buying out there, you might actually make this mistake, and it's pretty popular in the stock market. And that's why don't rush. Hold your money, wait, do your analysis, know what you're buying exactly before you actually throw any penny into any kind of a stock. Of course, when I'm telling you don't rush, I don't mean that never start investing, because there are some people out there, they've been watching the market for a year, two. Some people watch the market like 5-7 years. Now, I'm not telling you forever, just keep watching the market. First of all, of course, you have to educate yourself. You should know what you are doing exactly. You should know how to analyze companies. And when you do all of that, when you learn all of that, and you're getting to start investing, don't rush. Hold your money until you know what exactly you are buying. Well, assuming that you actually decided to invest, there is another thing that you have to keep in mind. If it's your last $10,000, please, for God's sake, do not start investing. You have to understand that you have your plans and the market has its own plans. And guess what? Nobody for a fact knows the plans of the market. The market can fluctuate, and your life can also fluctuate. Today, you don't need that $10,000. Tomorrow, something might happen, and you might need some cash in order to close that emergency. And if you sell your stock in the middle of that, then you are going to lose a substantial amount of your money when your stocks are down, for example. That doesn't mean that you have chosen the bad company. It just means that you have to wait longer for that stock to actually grow. And that happens all the time in the market. And you need liquidity, because if you actually get into a crisis and you need money and you use your credit card, for example, to pay for that, you're guaranteed to pay a 25% interest on that credit card. And that's why, of course, in the market, you can make more than that, but it's not guaranteed. You don't know for a fact if you're going to make that. But when it comes to your credit card, you are guaranteed to pay a 25% interest rate. And that's why if you're investing if you have like your last $10,000, it's far better to keep that at least for an emergency fund. If you want to invest the amount that you're saving more than that, yes, then it actually might make sense. Let's say, for example, that you actually decided that you want to actually invest and you have your $10,000 and you're thinking, what exactly should I buy? Now, there are different types of stocks in the market, of course, and I'm not going to go through all of the types of the stocks, but if you want to maximize your returns, then you're looking into investing into stocks and not kind of securities such as, for example, bonds or anything like that, or even dividend stocks, because dividend stocks don't really pay that much. Now, what you have to understand about the returns in the stock market is that, or any kind of market, the higher the risk, the higher are the returns. The lower the risks, the lower are the returns. And that's why if you take a look, for example, at US government bonds, you will realize that they don't really have high returns, because US government bonds are considered the safest investments out there. Another thing that you have to understand when it comes to risk is that you can lower down the risk the more you know about something. The less you know, the higher are the risk. And just because you don't have the knowledge to analyze a company, just because you don't have the knowledge or the skills to find future valuation, current valuation, and compare them to the prices, doesn't mean that that knowledge does not exist. So the more information you pursue about that stock, the more information you pursue about that company, the lower are going to be your risks, because the more accurately you can predict its future. Now, I'm not saying that you can predict it for a fact 100%, but at least the more you know, the more accurate are going to be your analysis. So there are three types of stocks that you're looking into. First of all, you're looking into something like index funds. Now, index funds are the most safest or stable investments out there in the stock market, and you don't have to worry about them. Yes, they also fluctuate. When the market is down, they can go down, but other times, for example, the S&P 500, which is probably the most stable stocks out there, other times they can grow by 20%. But if we take the historical numbers, for example, they grow by an average of 8 to 10%. It really depends of what kind of a historical period you're actually taking. The second type of stocks you can actually buy with that kind of $10,000 are probably some of the largest companies out there. Now, these companies don't grow by 1,000%. They can't physically grow by that kind of a percent. Let's say, for example, Nvidia, that has grown by 2,500% or something like that. Now it's worth over $3 trillion. For Nvidia stock to even grow by 100%, for example, it must grow to probably $6 or $7 trillion. Is that possible? Yes, of course it's possible, but it's very unlikely to happen, for example, in the next 2 years or 5 years, or maybe even longer than that. And for Nvidia, for example, to grow, for example, by 300%, then it must grow by over $10 trillion, for example. And that's why you don't want to, if you're investing in a huge company, in a stable company, you're lowering down your risks, but at the same time, it's very naive to expect anything more than 30%. And even 30% is extremely high, and it's not even guaranteed. Of course, risks are high with individual stable stocks, but nonetheless, you can actually make significantly more than index funds. Now, the third type of stocks you're looking into are small, tiny companies. And when I say tiny, I don't mean like tiny companies that worth like $1 billion. I'm talking about companies that already worth tens of billions of dollars, maybe even $50 billion, $100 billion. And these companies have an opportunity to grow by 200%, 300%, 500%. So for example, if you have a company that is worth $20 billion and it grows to $100 billion, which is entirely possible in the markets that we have right now, that's a 500% growth rate. That's not something you can expect from a company like Apple. That's not something you can expect from a company like Amazon. But you have to understand that with these individual stocks, you are significantly increasing your risks. And you have to keep that in mind. When you're increasing your risks, you can actually lose that money as well. And that's why you have to be extremely careful. Let's say, for example, that you decided to go with smaller stocks because you can actually expect to make from them 200%, 300%, maybe 400%. You see, no matter how much analysis you do, at the end of the day, you can be wrong when it comes to these small companies. So if you're actually analyzing an industry, you have to pick up, for example, 3 to 5 top companies that are working on a certain technology. You don't know for a fact which one of them is going to succeed. And that's why, most importantly, don't diversify into a lot of industries. But in the same industry, you want to look into multiple companies, into at least 3 to 5 companies. At the end of the day, if you take a look at any industry, you will always find out that 1 or 2 or 3 companies are dominating that industry. So in order for you to be safe or be on the other side or be confident that you are going to make some money on your investment, or you are actually going to hit that company that is going to substantially grow, you want to choose, let's say, 4 companies or 5 companies and invest by $2,000 in each of them, and that will amount to $10,000. Maybe one of them will fail, maybe 2 of them will fail. But if you get that one company that is going to make it in the market, then it is going to turn into tens of thousands of dollars, maybe hundreds of thousands of dollars. It really depends on the company and the time frame that you're actually holding that stock and how high that stock is going to grow. No matter what kind of investment you actually made, you have to keep in mind that you have to be extremely patient in the market. You see, no matter what company you choose, no matter how great that stock is, no matter how charismatic the CEO of that company is, at the end of the day, for anything meaningful to happen, you need to be patient, because you need to give the company the time to actually do whatever it's doing, to innovate the technologies they are innovating, to grow the business, to expand the business, sell their products, build their logistics, whatever they are doing. So if you're not actually patient in the market, you are going to suffer and you are going to just literally lose all of your investments. Another thing you have to understand is that the growth in the market is not proportional. Like, some people imagine that when they're investing in the stock market, let's say a stock has grown by 1,000%. It's not like it has grown by 200% every single year. It does not work like that. Like, it can actually don't grow at all in the first year, second year, third year, and then in the fourth year, it might actually just explode. Like, the growth in the market is always exponential, just like this. And that's why if you actually sell here, for example, you have lost it. You might actually sell it right before that exponential growth actually happens. You don't know when that happens. Now, take Nvidia. Nvidia has been in the market for like 30 or 40 years or something like that. And until 2020, their valuation was like $150 billion or maybe even $100 billion. Now, within a span of 2 years, they went from $150 billion to something like $3.5 trillion. And that's not just the case with Nvidia. It's literally the case with every company out there. That's it for today. Thanks for watching, and I will see you in the next one.